Right, hi everyone. I'm Matt. I'm a partner in our financial services team. So I was going to talk to you briefly today about debt finance. I was going to touch on what's available in the market. How you should prepare, how you might think about going about getting it. So there's sort of cycle around there. So the first thing really about this is to try and work out realistically what do you want, and that kind of depends on the nature of your business, where you are in your sort of cycle. Are you pre-revenue, post-revenue, pre-profit, post-profit? Because there are different financing structures out there that are relevant to different companies and different sectors. So the key is to establish where you're at and what is available. So I thought I'd just set out very briefly some of the different sorts of finance that you might think about going to obtain, and talk about very briefly the different characteristics of each one, so you can try and apply them to your particular business and understand whether or not that is something that will be relevant to you. So I set them out there, and I'll sort of touch on them, and I would say just ask any questions if those are relevant as well. Just feel free to stop me at any time. So one of the forms of finance that can be quite useful is what we would call invoice discounting. You sometimes might hear it as factoring. That would be relevant to a post-revenue business, obviously, because the key to this is that you're generating debtors. The Americans would call it receivables. And what that does is it provides financing against the value of the invoices that you'll issue to your companies. So you might have quite long payment terms from some of your customers. So they might be paying you on, say, 60 or 90-day terms, which can be a problem for sort of early stage companies, growing companies, to get that cash flow through. So the sort of purpose of this sort of financing is to try and accelerate your cash flow cycle. So you don't put an invoice out the door and then have to wait for 90 days to get paid. So there are various providers. I sort of set out a few at the bottom as to who would do this sort of stuff. And you set up a facility with them. They can be fairly standard form, these, fairly easy to put in place. And you would sell your receivables effectively to that financing company at a discount, which is why we call it invoice discounting. So if you had a debt for £100, you would sell it to a invoice discounting or a factoring company for, let's say, £85. They would advance you £85 on day one. So immediately upon that invoice being issued, so you've got the cash in, so it's helping with your cash cycle, and it flows through. And it's obviously designed for where you've got several invoices coming through, so the cycle is flowing around there. So who's that relevant to? It's relevant to companies, obviously, that are post-revenue, starting to generate debtors. It's quite good because you can also, some of these providers will do what they call credit insurance. So if there are defaults from the underlying debtors, then they will cover them via an insurance product. But that comes at a slightly extra cost, albeit not on a material extra cost. So it can be something that's worth thinking about. So to say the advantages are fairly quick, and it can shorten your invoice cycle. Disadvantages, obviously you're paying them a financing fee for this, and you can lose control of your ledger as well. There's a difference between what we would call factoring and what we would call invoice discounting. Are people aware of that? No? Okay. Right. Factoring, you literally outsource the whole thing to a company. You outsource your entire ledger. They manage it for you. They chase your debtors. A lot of people don't like that because they want to be in touch with their own customers. They don't want some finance house sort of banging on the door when they miss a payment by one day. So a lot of people go for invoice discounting, which allows you to keep your sort of ledger control in-house. That's one form of financing that might be available. Another form is asset finance, and that can be relevant for companies with assets. Obviously, traditionally it was designed for companies with plant and machinery, you go and finance that, vehicles and the like. But more so in the sort of tech space, it can allow you to go and acquire, computer equipment, sort of hardware and the like. So, you would go to a finance house like a Close Brothers or a Santander, and they can provide finance against the value of your assets. The advantages are, that they're fixed payments and interest rates, so it's fairly predictable in terms of what it's going to cost. It's also relatively easy to obtain in the sense that if you've got a valuable asset that is recognised and a financier could, there is a sort of a secondary market for it, so it could be sold. Then a finance provider would very often provide some kind of funding against it. The disadvantages of that, obviously, some of these assets will depreciate over time. And also the crucial one here is, if you don't keep up the repayments, it's like that sort of thing you see on the billboards. Your house will be repossessed. It's very much that kind of thing. What else is out there? You can just go and borrow a standard loan from the bank, but this would be generally only available to, usually available to companies that are certainly post-revenue, probably post-profit as well, because that is very often premised on cash flow. So they might lend you £10,000 to go out and buy, equipment, buy a competitor and the like. Key providers would be, your traditional high street banks, but also much more these days, you get the sort of challenger banks that are entering the market as well, and alternative capital providers as well. The advantages of these, certainty of terms. Currently, it's actually very low interest rates at the moment, but obviously the rate of interest that you'll pay depends on the sort of perceived credit risk as to your particular business.
But this would be unsecured?
Secured or unsecured. Okay. So very often if you provide some form of security, it would usually push the price down because obviously the credit risk is better. What else might be available? What we call revolving credit facilities. They can be committed or uncommitted. A sort of an uncommitted revolving credit facility, think an overdraft or the like. A committed revolving facility, so an overdraft can be withdrawn at any time, whereas a committed revolving facility, a bank or some kind of funder would agree to provide you with a revolving line of credit over a period of time. The advantage of sort of revolving facilities are they're flexible. You can redraw and reborrow over time. The disadvantage is you pay what we would call a commitment fee to have that sort of level of committed money for a period of time. So banks or other finance providers have a sort of a finite balance sheet, and they would generally, if they commit to give you a pot of money over a period of time, then they would, it means they can't lend it to anyone else. So even though you've not necessarily drawn that cash, you would still be paying for the fact that you've got it available to you. So you tend to get the sort of previous historically from your sort of traditional banks, high street banks, clearers, asset-based lenders. But these days, in the last sort of 10 years, really, there's been a sort of an explosion of different funds that have come onto the market. That are targeting specific businesses, specific sectors, and that's private capital, and they are quite often a bit like private equity funds in the sense that they would raise a pot of money specifically for lending, direct lending out to corporates and the like. And there are quite a few of those that target newly established businesses, tech companies and the like, and they're a lot more flexible typically than your sort of traditional high street banks. And and they very often offer sort of more sort of tailored solutions and one consider sort of non-standard products. So they are worth thinking about. I mean, again, I've put a few down on the slide there as to who are sort of out in the market now providing sort of growth capital type solutions as well. The disadvantages is they typically are more expensive than banks, and the sort of they will, quite often charge additional fees, have higher interest rates for that flexibility that these sort of people will provide. But they are out there in the market and are becoming very popular. You've probably all seen crowdfunding out there. Your likes of Kickstarter and people like that. They are a viable source of finance potentially. It can be fairly quick, but in terms of the disadvantages, it can be fairly expensive, some of those processes, and also there can be the uncertainty of raising the sort of target amount that you need, because obviously you would go to one of these crowdfunding sites and say, I want to achieve X. You may or may not get there necessarily. So if you've got a project that you definitely need to try and finance, then crowdfunding is worth looking at. But it's to be aware that you might not necessarily hit your target returns. And then there are lots actually of sort of grants out there and sort of government, quasi-government schemes as well that will provide support to startups and businesses, particularly in sort of local regions. So Manchester has them, sort of GMCA funding over in Yorkshire as well. They have similar sorts of funds out there, so they are worth considering. From the government, from local authorities, people like the British Business Bank as well. Quite interesting. If you guys have come across those, they're worth exploring, because they have some. Again, they have three schemes, effectively small, medium, and large, in terms of how much you want to try and raise. But the thing with some of these is they often come with conditions around you've got to establish, base yourself in, let's say, Manchester. You've got to employ, 5 people in a certain number of times. So it's not necessarily financial returns that these people are looking at. It's financial, but there are often other sort of bits that come along with it as well. So I mean that was just a sort of a very, in the space of sort of 10 minutes. I mean, I could have gone on for hours about this, but given the time. That was just a very brief overview in terms of the types of funding that might be available. So the key to it really then, so you've worked out what your business is, what stage are you at, what is an appropriate or potentially an appropriate funding source for you. How do you prepare? From experience, and when we sort of talk to these people all the time, they're sort of exacerbated by people who just come in totally unprepared. So the key to it, is make sure you sort of, set up properly. Don't go sort of in just randomly asking for a loan, because you'll likely get shown the door. So make sure, you've got, in terms of business considerations, compile a realistic business plan. I mean, it's key to have that. Have a proper budget, have a proper business plan. Financiers, if people come in with sort of back of a fag packet type calculations, then they just won't be. It goes to the whole credibility thing, which is what they're what a lot of this stuff is premised on. In terms of sort of financial stability, are you have you done the sort of basics? Have you filed accounts? Have you got management information? All that sort of stuff. They will be they'll be interested in that, and making sure that you've done that. In terms of if you go and say I own this particular asset or process, make sure that's properly locked down to the extent you do. If you, as Kerry was saying earlier, if you've got trademarks or something like that, make sure they're properly addressed. So effectively, get your house sort of properly in order, and and you will have a much greater chance of success if you go in with sort of well prepared and reasoned kind of requests. And then how do you obtain? I mean, you got to be realistic about this sort of stuff. You can't, if you can't go in asking for the earth if you don't necessarily need it. Determine what you really want. What are you trying to achieve? Make sure you're sort of, you've got your documentation in order to the extent you can, and then allocate the sort of appropriate time and resource to try and deal with this, because it can be quite a long process to get some of this finance, particularly if you're in a sort of an innovative sort of sector. These financiers want to get their heads around what your business plan is, what your business models are, where you're going to go. So do allocate the time to deal with it.